Hello and welcome to Wire Talks. As we have seen over the last few years, inflation and cost of living crisis is hitting everyone in the world. As inflation started to inch higher, central banks responded by increasing interest rates. The idea being eventually to cool the economy, but not as much. So what happens? As central banks starts to increase interest rates, they start hitting the wage growth and the GDP growth or the economic growth. What is thus a hard landing? Hard landing becomes when you see unemployment increasing substantially high and GDP growth turning negative. As an official statement, GDP turning negative for 2 quarters in a row, which is a recession. That's a hard landing. What's a soft landing then? In a soft landing scenario, the central bank raises interest rates just as much to make sure while there is unemployment, but unemployment does not rise significantly, is manageable. B. GDP slows but does not go to a negative territory, slow down just as much to bring overall inflation down. But at the same time, we are also seeing, as we are seeing globally, whether it's Australia, the latest numbers, the US, India, for example, inflation has been steadily inching lower. And if the central bank manages to bring the inflation lower while not making unemployment really high or ensuring GDP remains in the positive territory, they have achieved a soft landing. Managing a soft landing is not impossible. We have seen instances where the central banks globally have managed soft landings for their respective economies. So, in this current context now, what are the opportunities for investments? Let's look at India first. While the price earning multiples for both Sensex and Nifty remain relatively high, the markets are ably supported by strong GDP growth, strong corporate earnings, and definitely strong flows into the market, especially from the domestic/retail investors. With inflation moderating, RBI keeping the interest rate steady at 6.5%, one could look at investing across small cap, mid cap, or large cap entities within India as per risk appetite, because each entity would have its own volatility, with highest for the small cap and relatively lower for the large caps. That's one idea. In terms of fixed income, where the 10-year treasury or the 10-year government bond is currently trading just upwards of 7%, investors who are looking for risk-free investments could also tap this opportunity. And as you see with the link here, RBI has a platform where retail investors can invest into fixed income securities by themselves. From the US market perspectives, while there have been certain red flags, including the fiscal situation for the US and the more recent slowdown in the services sector, do look at big tech within equities, including the AI or the artificial intelligence space, along with cybersecurity. Do also look at the climate change themes, the renewables in the US or specifically in European markets as well, and other economies like India, which I mentioned earlier. In terms of fixed income, those who lost or missed an opportunity of investing earlier, the yields, the 10-year is back again just over 4% right now. It could probably inch up a bit more if inflation on Friday the 12th surprises on the upside. But at the same time, if inflation does come off sharply, you might see yields coming off too. But at the same time, like I mentioned for the US, the yields could still remain a problem over the medium to long term if the US fiscal situation does not improve. Look out for the next video for some more ideas across these segments. Please do like, subscribe the video with the bell button and the icon below. Please leave your comments and thoughts and any specific segments or ideas you'd want to be covered during such videos. Thank you.